Hey traders, how you going? Alright, so it's a beautiful Saturday. I'm sitting here with my coffee and a number of Tim Tams, and I thought I'd make a video for you guys. I just logged in to see what the market did, finishing off yesterday for a number of currency pairs. I did a trade on Forex on this one, and this was such a clear double top. I thought I might as well create a video around Forex because I'm getting a lot of you asking me Forex questions now. So I'm going to run through a number of Forex questions that I have received, and we'll run you through some of the familiar points that you really need to look for when you're trading Forex. I'm going to make it as simple as I possibly can, and many of you that know me know that I like simplicity. I'm not going to give you fancy names of candlestick patterns or anything like that because it doesn't really matter. You just need to be able to visually recognize something and understand that the market is doing what you possibly are predicting. If you can see those signs, then there's a great chance they're going to do really well at trading Forex. Now, for those of you that want to learn how to execute a Forex trade, and draw in support and resistance lines and things like that. There's a video on my channel called Simply Forex. It's a pretty lengthy video, I think, half an hour or so more. Please go have a look at that. That will explain to you more about pips, how much you get in terms of lots. So you've got the full lot, you've got the mini lot and the micro lot, and how much you would get in return in terms of how many pips you collect. So all of that stuff will be explained in that video. Please have a look at that. I think that's it. So let's jump straight into this. Now, here are the components to looking at trading Forex, okay, or how to trade it well. First off, patterns or the structure of the market is king, right? A lot of people, and this is the mindset mistake that is actually always made, it's where they would think that the market is going to go head in a particular direction, even if there's no signs from the market that this is what I'm doing. And then they'll sit there and they'll pray that please go up, please go, just please go up a little bit more, go back up again. And that's never going to happen. So here's like, when that old saying, what is it that you would do to a 5,000 pound gorilla? Nothing. You pretty much let it do whatever the hell it wants to do, right? So in this case, what you want to do is tap into the pulse of the market and understand where it wants to go. Let it go wherever it wants to go, and you're going to go for a ride with it. That's the whole point. And what we're doing is, one thing that people often say when we're doing these videos is, well, why are a lot of teachers teaching you what's already happened in the past? As opposed to doing these things real time. These things can't be taught in real time. Why? One, I'm doing my own analysis of what's happening in the market, and two, you've got to be able to grasp. You need to be able to look at what's happening in the market, or what's happened in the market, and look at it over and over and over and over again. Because when you see that something's happened, this is like an imprint that you're trying to grasp. When you see that, then you see that the next time your subconscious mind is going to recognize that. Right? You can't jump into training something without actually knowing and seeing and understanding what's actually happening. Explaining some of those things in real time, I've tried this before. We used to teach people some of these things before. I don't see how they can grasp it that quickly. And a lot of the times, if I'm caught between doing my own analysis and also trying to wrap this knowledge around someone else's thinking, you miss so much. So this is the reason why we kind of go back in the charts and say, okay, this is what we're looking for. Because when you can actually see that, the next time when the market's doing it in real time, you'll see it. Okay? Two, besides pattern and structure, support and resistance lines can and will help you. It also depends on whether or not you are either a swing trader, if you pretty much just going in to collect a certain number of pips, which is what I do. So support and resistance, again, in some respects it does help. The Cordis theory will help you there as well. Especially if it's again just a point of confluence where you've got this prediction in mind and the market and you've got these points where you know the market's going to hit and bounce back from, and if you're one of those people that would like to put pending orders in because you're pre-predicting beforehand, certainly you can do your support and resistance lines as well. Wicks, in my opinion, they tell you more than the actual body of the candle can. Okay, when I'm looking at the charts, I look for the wicks in terms of structure. The wicks will always tell you where the market is not heading anymore. Okay, so if the market's pushing up and then comes back down, I'm looking to see, for example, here, I'm looking to see if the wick or the body breaks past this line here. If it doesn't, in this case, this wick broke past here, still didn't break this past here. We've got 1, 2, 3 weeks here now. We've got a couple of weeks here. What this is telling me is that at some point, the market is going to go for a reversal again. It's going to pull back. To what point is it going to pull back? Well, that's dependent on past structure. And then I utilize my key tool, which is the Fibonacci tool here. And then we try and figure out to what point the market may bounce back. Okay, you've all heard me. Well, some of you might have seen that video I've put up regarding the 61.8, the golden ratio, in terms of trading binary off of that. We do the same thing. Actually, primarily we use it in Forex to see a continuation of a trend. Someone did ask me, someone actually swore at me in one of the comments below in regards to me saying that when you see consolidation happen, that is the possible end of a trend. And he said, no effing way. Now, here's the key thing that he needs to be aware of, and so do you. So if I can zoom out a little bit here. Now, say for instance, we're here, and the market is consolidating, right? Now, the market does move in waves, it moves in levels as well. Now, say for instance that you're looking to collect a certain number of pips, and you certainly do that, and then the market pushes back and starts to consolidate, right? Now, he would be correct in saying that the market consolidation here is pretty much just fake outs. It's the market's taking a bit of a break before it does continue down south. Now, I think it depends on what sort of trader you are. On a 4-hour chart or even a daily chart, I possibly will consider his argument to be correct, because in those levels you won't see this consolidation. What you'd see is a slight pullback on the candle itself. Right, so if you've got like a red candle, this would create a bit of a wick before the market pushes back down again. You've got to decide also the duration in which you're comfortable trading. Some people, it's nerve-wracking when they're doing anything that's over like a 10-hour trade. Do I trade 10-hour trades anymore? No, I don't. I don't like to be in the market that long. So he would be correct in saying this is not the official end of the trend if it's consolidating like this. But again, you got to understand what sort of trader you are. Now, if I was to see this sort of a setup, which is like a bit of an evening star pattern here, market pushes down and I take my trade here, market pushes down enough, let me see how many pips I'd collect there. Say for instance I'm doing 30 to 50 pips, all the way down here is about 62 pips, all the way down here. I pulled out, say, at 50, somewhere along these lines, and the market starts to consolidate. What I would do is I would get out of that trade. Why? Because I'd say this is the effective initial end of this trend. Now this, from here to here, let me collect count the candles, that's 4, that's 1 hour, 2 hours, 3 hours. So it's about 3.5 hours before the market breaks past, well, close to 4 hours actually, before the market breaks past the low of this. Now, would you be comfortable in sitting there for 4 hours while the market consolidates, especially when the market, you're going for a 50 pip move and the market bounces back, say 28 pips? How are you going to feel around that time? Half your profits just disappeared. would you know that this market was going to push back down again? Or would it be something along these lines here, where what you would consider to be your consolidation and then market pulling back up, but eventually the market doesn't push back down again, just keeps going? That's why we say what you're looking for is signs at the top here somewhere where the market is going to head south. And I believe, let me get rid of this. I believe this actually might be a bit of a head and shoulders pattern here. So when you're seeing something along these lines and you see the market push down, here's your entry point here. You take a trade. When the market starts to consolidate, you get the hell out of that trade, and then you wait for another opportunity. Now, you probably would do some analysis and say, okay, I'm getting wicks to the high here. This is going to be a continuation because, if you do the ABCD pattern, for example, followed by we're starting off from a head and shoulders one, and you clearly have seen this is, the market within the weekly structure has moved in a certain direction. It's reversing. It's going to move in the opposite direction. So what you're expecting is a drop, consolidation, another drop, right? If you understand that, you exit your trade here, and then you look for a sign for another entry somewhere else. Don't be a fool and think that the market's going to continue riding for 100, 150 pips, 200 pips. This is where you're going to have losses occur, because you may just end up in a situation like this when the market comes back down. You thought this is going to consolidate. You see this stop hunt high and you think, yep, you know what, the market is going to keep tumbling. Here, let me just do a calculation on this. From that point here to say that point is about 40 pips. Come all the way, that's your 50 pips, right? Yesterday I traded 30 pips off of this. I entered a trade up here. We finished off somewhere in this candle. I was out. I didn't care if the market was going to tumble another 100 pips. It didn't matter. I maintained my consistency by collecting a certain number of pips, and I'm in and out. Okay? So when you actually see consolidation happen, that can mean effectively the end of a trend. So for example here, we've got a bit of a consolidation, market climbs, and then consolidation again. Pulls back, goes up, pulls back, goes up. When we see that, it's the effective end. This is about 3 hours right here. Would you, and your trade, if you would have taken it, possibly would have been after this pull. You could have taken it in any of these candles here. I probably would have jumped in somewhere here, and the market started to push back up again, right? So say, for instance, you did from here till about here, which is the 200 EMA, that's about 30 pips. I would have been really comfortable with that. Now, this is a 15-minute candle. This wick went and hit this. Whatever it got to that point, I would have been happy to jump out of that trade. In 15 minutes, I'm done for the day, right? If I would have traded 10 lots off of that, 30 pips, that's $3,000 for me. I'm very, very happy. If I'm doing that on pounds, convert that to Australian, that $3,000 would be something like about $5,500. That's not bad, is it, for 15 minutes? So you got to look at it that way. I would not sit here for 3 hours trying to figure out if this market's going to go push back up again or it's going to pull back down again. If I was to, can you imagine now? Here's where you apply life, everyday life to Forex. And this is why I say to you guys, it's going to make you more spiritual. You're going to understand your life better than you ever have. And the reason for it is this. You never really have moments in your life where everything is just so perfect, right? You're constantly moving in one amazing direction. Life is like steadiness. Pain is pretty much abundant for us. Your moments of happiness and joy, and this is what a lot of spiritualists will say, is the absence of the pain and sadness and stuff. That's simply it. It's you have bursts of joy in the absence of pain and sadness, right? And what that usually does is you have these bursts of energy, moments in your life when you're inspired, when you've got your passion, when you've got physical energy pumping through your body, and you move rapidly in a direction. There's going to be a time when you slow down, something like this, and you take a bit of a step back. You will have to slow down. Even when you're running a marathon, you're not bolting. for that whatever 15Ks or however long a marathon is, you're not bolting that whole entire time. There are going to be moments when you do slow down. There are going to be moments when you need to drink some water. There are going to be moments when you probably stop and take a walk. So you do pull back. That's what the market does. And when you understand that, what you're trying to do is tap into those bursts, those moments when the market is actually going to head in a particular direction, when you know this directional move is going to happen because the structure is showing me so. Then you're looking for signs from the market makers, from the dealers, from the market itself that, okay, I've completed everything I need to complete in where I am. For example, this massive spike up to the top and then push back down again. I've completed this. We've trapped traders up here. We're going to now move in this direction. Once you have that confirmation done, and in that regard, do not try and jump into a moving candle. All right, this is where a lot of people go wrong with NFP trades or news trades, where they will quickly try and jump in. There's going to be slippage, which is going to absolutely destroy you. I have seen people wipe out like thousands off their account trying to jump in, and then there's slippage of 30, 40, 50 pips. Don't do that. Please don't do that. So what you want to do is you want to make sure this candle finishes off before you take a jump into the next candle, right? So the structure has to complete. It needs to show you, okay, this is what I'm doing because this is my confirmation to you. It's the same thing in life. You just don't automatically jump into things. We look for signs and we plan things out. And when you do plan it out and you see those moments happen in your life, you're kind of pretty much confident that, yep, the direction I'm moving in life is justified. For example, marriage. A lot of people tend to have this attraction to people, and there's a lot of lust involved there, and then they'll jump into it, and they'll be like, I love this person. But they don't. It's psychologically, it's this thing within our mind. People call it the honeymoon phase, where you're going through this burst of ecstasy. And in your mind, what you're seeing is everything that you want to see. You're not actually seeing the truth or the reality of the situation. And what tends to happen is that once that wears off and you start seeing the person for who they really are, you all of a sudden realize you don't love them. Right? It's the same thing with the markets. You might get caught up in these massive moves that tend to happen all of a sudden, and a lot of people try to jump in them. And then, for example, here, this would have opened here, and then at some point, this would have been a massive green candle, right? Imagine you saw this momentum happen and you jump right in, somewhere around here, because you're thinking, hey, you know what? I'm missing this trade. You jump in. By the time you jump in, the market's up here somewhere. And then what happens? They pull back on you, okay? Let's measure the size of this candle. It's 35 pips. So depending on the size of your trade, you either would have lost a significant amount of money. If you had a tight stop loss that would have triggered you off, you would have lost something. So in life and in trading Forex, what you've got to understand is, one, look at the structure. Look at what's happened in the past, right? You're going to change how you approach this. 2, understand exactly what you're getting yourself into. 3, let life and let the market complete whatever it's doing in the interim, and then base your decision around the confirmation that it's already made. Right? Fantastic. Next question. Do I personally swing trade or do I collect pips? I like collecting pips. Okay. Swing trades are great for day traders, I think, in my opinion. I personally like only being in the market for maybe 30 minutes, an hour at the max. Why? Think about it this way again. If I'm looking at trading, say, 30 pips, 50 pips a day maximum, and I could probably even do 100 on multiple currency pairs. But if I wanted to just do 30 to 50 pips, I could possibly trade the false moves as well as the actual trend. Chances are I might be in and out of the market on 2 or 3 of the 15-minute candles, which is fantastic for me. And if I actually do catch the right setups, which can happen for me, like, Friday here, this can happen easily about 3 or 4 times a week. You can get this daily as well if you know. So, for example, if I see a double top pattern and the market does move in a particular direction, and I know that the market is going to bounce back up from that point, at least 50% of what this move is. So if I look to see this here, and this would be during the week, not on a Friday, so that's 180 pips, 18 pips. I know that's going to at least move back up at least 60 pips at some point and then pull back down again. I could actually trade both ways. Trade this, come back another day, trade that, and then trade the back down again. So I can make my 30 pips every single day. If I'm doing 10 lots of my 30 pips, that is 3 grand, and I think I've said it before, it's like 5,000 something for the day, Australian. I'm done for the day. If I'm only also hitting my 30 pips and I'm in and out, I can be consistent every single day, right? So I'm not taking any unnecessary risks. I can actually rely upon the income that's going to come through tomorrow, a week, a month down the track, because I know I'm confident enough that I can hit my 30 to 50 pips every single day. Again, if I'm doing multiple currency pairs, I can hit that at least twice a day. I could probably do 100 pips or so. I'm looking for the ideal setups. Your swing trades can be okay, for a lot of people, but you'd probably still have to apply the same principles in relation to confirmations from the market that wherever you're kind of thinking the market's going to swing to will definitely happen. Keep in mind, it's not always going to, the market is not always going to respect where you draw your support and resistance trades in, because, say for instance, the monthly or the seasonal targets are something different. And so the market is actually moving in a specific direction as a result of it. So it could plow right through your support and resistance zones. So there, you want to be able to pay attention to market structure. Extremely, extremely important. So you've got your double tops, your double bottoms, your triple tops, your triple bottoms. There's specific patterns like, the ABCD pattern, and you've got your head and shoulders pattern. What I'm going to do is, there's about 10 patterns that I specifically will recognize myself. What I'm going to do is I'll create a separate video that will just identify the patterns for you guys, okay? So when you see that, you know that that's a point of confluence right there. The pattern, third wave up, stop hunt high, market pulls back drastically. You've got a wick, so here, third wave up, stop hunt high, market pulls back drastically. Probably you've got the EMA 200 here as well. So I always look for, if I know the market's going to move in specific waves, I always look for behaviors around the EMA 50 and the EMA 200. Okay, when you see that the market breaks past this, consolidates, pulls back again, goes up, breaks past it, you're going to stop hunt high above the EMA 200. That's another point of confluence. The market's going to pull back down again. All right, so you need to be able to look at stare at the market yourself and develop these kind of pieces, that make up your criteria. Just by observation. Don't worry too much about technicalities of what they're called, what that means, all of that rubbish, because at the end of the day, it doesn't really matter. All you need to be able to do in Forex is know that the market's going to head in a particular direction. It's done everything it needs to up here, and there's nothing that's going to justify the market pushing back up again, even slightly. And if you know you're going to be in it for, 10 pips, 20 pips, there's going to be very little opportunities for you to go wrong. Even in a false move, especially when you're trading, say, a pound pair, even in a false move, the market could move about 25 to 50 pips. When you're looking for maybe 30 pips max or somewhere close to, even in a false move, you can't go wrong. You would have still walked away with about 25, 30 pips, right? You can be in and out before the trend actually even begins. So, and sometimes the actual stop hunts can be about 25 to 50 pips. So even if you've chosen the wrong direction and you jump in and the market is moving back up and you're out, the market pushes back down again to reverse direction, you've already jumped out, you've already made your profit. Okay, next question. Which currency pairs do I actually prefer when I'm trading Forex? For Forex, I absolutely love the pound pair, so I'll do my four favorite for Forex would be pound JPY, pound USD, pound AUD, and pound NZD. My absolute favorite would have to be pound AUD. It's more predictable, and the pound pairs really move. You know, when the pound pairs actually do move, you're looking at a movement of about 100 to 150 pips, right? When the euro pairs move, sometimes you're only looking for a maximum movement of about 70 pips. And especially, you know, a lot of people out there tend to trade the euro USD. It's okay, you know, you've got a lot more liquidity within that, but I find that it's also a little too slow moving for my liking. Whereas the pound pairs, you know, you could get like a 25 pip movement in one candle. Actually, let me prove it to you. This candle here, this is where I took the trade. Now, from the top of the wick till the bottom of the wick, that's 31 pips, right? This one here, top to bottom, that's about 23 pips. Now, if you actually select your trades well and you're only looking for maybe 15, 20 pips, you can get that out of one 15-minute candle. So my absolute favorite is the pound AUD and pound NZD. They move a lot more. Your broker probably will require a little bit more margin. So if you're doing like a 10-lot trade, the margin on this might be, say, about 1,300 or so. As opposed to maybe about 900 with the euro pairs, right? It doesn't really matter. If you know your directional move, you're going to make really good money off of this. And the margin on this might be slightly higher as well. Sorry, the spread on this might be slightly higher as well. So don't worry about it. Again, if you know you're going to move about 30 pips and you're going to collect that, even a 2.5, 3 pip spread isn't that bad. Even if they gave you a 5 pip spread, that's not so bad. But you will make decent money out of this. So that's my absolute favorite there. What tools do I use? The only tool that I really like to use is the Fibonacci retracement tool. Now, here's the thing. Say, for instance, here, right? I would say this is a stop hunt low a little bit. Market pushes back up. We consolidate, and I want to take an entry off here, right? I take an entry off here. Consolidation happens. I would exit my trade at the EMA 200. Market consolidates. Now, I'm expecting that the market's going to do somewhat of a bounce back. Remember, life moves in waves, so does the market. I'm expecting a pullback to happen. So what I'll do is I'll grab my Fibonacci retracement tool here. Keep in mind, wherever I start, wherever I drop this initially, is where the 100% line is going to be, and then it's going to work backwards towards the zero, right? So say, for instance, I want to calculate to what point the market's going to retrace, and I'm looking for a bounce of the 61.8 or even the 50 or the 38.2, then I would draw my 100% line down here, because again, the 61 would be here, 50, 38.2, something along those lines. So I'll drop it there and drag up to the very high point that I can find. So initially I'd say market's done its thing here and it's starting to pull back slightly. So I would use this as the high point, draw it in, and then look to see what the market's actually doing. So in this case, it bounces off the 38.2, market moves up, hits the EMA 200, and notice how you guys can use this on binary trades as well. I've noticed this. There's always going to be somewhat of a wick. In this case, it hits it, bounces, so this market breaks right through. You're also going to see this quite often as well, not all the time, but when a candle breaks through, especially after a trend candle bounces off over the EMA 200, you could possibly look at taking this trade here. It's going to bounce back over again. Notice how it does the same thing here. And this is best during the consolidation phase, after a trend has happened. So this is the trend. This is a consolidation phase, and oftentimes you'll see this. So you could probably look at doing some of your binary trades this way, right? Here, wicks to the high. So I'm thinking, well, a couple of things. Session. Keep in mind this is the end of the Asian session, so market's not going to automatically jump going up off the 38.2 here. So I'm expecting that the market's going to fall a little bit more. What I would be assuming is at least the 50% line, right? So market keeps falling down here. Binary traders, you could look at doing a hit off the 61.8. Remember, establish your buffer. Look for a point where you'd like for it to go, and then you can do a reversal off this. I don't always do it off the 50. You could consider doing it off the 50. In this case, you probably would have considered it because you've got the EMA 50 bouncing off there as well. But I personally don't. It's more risky that way. So anyway, I'd wait for the market to bounce off here somewhere. Now, what I'm looking for is possibly candlestick patterns, some sort of confirmation that the market is or has confirmed its bounce. Now, I don't see anything in particular that is going to say, okay, this is the confirmation market's going to, you could call this a head and shoulders pattern slightly, but to say the market's going to continue going up this way, especially when we've had, say from this point to this point, like an 84 pip move, that the market's automatically going to go for a climb, for, you know, like a second trend run. So I'd probably at this stage not do anything with that. Now, just quickly off here, I think, okay, something I wanted to show you. Okay, here, pound NZD. Okay, so say for instance you've got a W pattern or a double bottom formation that's happening here, and we are here somewhere. You're looking to see where the market's going to most likely bounce back from. Now here's a key thing that I would always wait for, okay, especially in Forex. You're looking for your setups. If you're not trading the Asian session specifically, you're looking for your setups to happen early on in the London session, so somewhere during the transition here. And if you don't see it happen, I'd look for one that's somewhere towards the end of the London session and then possibly early New York session, right? You can actually correlate this with news releases. So check Forex Factory, check investing.com if you want to see if there's any key pieces of news that's going to be released. So any of the, say, the three bullheads or the red folders, if you see them, chances are that the dealers will actually delay any sort of significant move until they actually see the news release happen. And around the news release is when you're waiting for stop hunts to happen, right? So in this case, what I do here is to say, okay, here's my high point here, and this is at the transition of the Asian session going into London. This is my low point here that was the official low of the Asian session. So I'm going to draw my Fibonacci point from here to here, and the reason why I'm doing it this way is because this is a bit of a climb. I'm expecting for the market to pull back to a point that I can recognize, right? And once it does, then I'm looking for key like candlestick patterns or something along those lines where the market's showing me that, okay, we're ready to move in the direction that you're predicting. So I'll look at this and say, okay, this is a somewhere around here would be the start of London. This is the first four candles here is Frankfurt. I've done it that way because sometimes transitions can actually happen in Frankfurt. So this is the official open of London. Market tumbles. Still, there's no clear sign for me that this market is going to head up. So it's consolidation, market tumbles again. This is at the 50% line. Market tumbles again. Now here you could probably look at this and say the market's most likely is going to start climbing because here's a bit of like a morning star pattern off the 61.8 line, right? And you could possibly take a trade off the pullback of this candle. Now, here's the thing that I would consider. I'd first say, okay, chances are that this may be the move. And if you were to jump into this candle, there you go, right till the top of that is about 30 pips, right? And if you're collecting your 25, 30 pips, you're done, right? What I would also consider is that at this point here, we're roughly about an hour out from the open of the New York session. I'd jump in and I'd have a look to see what news releases are about to happen. If there isn't anything significant in terms of news, then I would start considering that chances are the market is either not going to move at all or significantly if I'm requesting it, or that this may effectively be the move, right? If I'm actually sitting here somewhere, I could have taken this trade, but I'd probably be a little bit wary. I'd rather miss a trade that ends up running for 500 pips than to jump in just for the heck of it, right? Here's the other thing that I would consider. Now, I'm going to look at a pair like pound and NZD that can move quite significantly, right? Here's a 137 pip move during the Asian session, and by right you would expect it to move during the Asian session. New Zealand markets open, and then you see consolidation, and during the London session the maximum we tend to get is about 85 pips, right? I would expect that the market will most likely not move significantly because it already has done a drastic move here. If this was like, say, well and truly below 100 pips, I would consider this consolidation to effectively be a trend run beginning here, or I would say that if there is some news, pound related, then chances are market's going to come back, bounce, and then go for a trend run. But if I've already done the 137 pip move here and the market's consolidating here, I would be wary of taking a trade here. Okay, remember again, you want to be so confident about your trade that there's no doubt in your mind this is going for a sixer if you're doing cricket, for example. So I'd put off taking my entries and wait and see what happens in early New York session. All right, so here again, I'm waiting somewhere around here. I could even consider, and it'll be like, the size of the candle, the market's a little bit unsure. I'm not sure if there's any news releases happening. And then you see this 3 hits to the low. This is bouncing off the 61.8, right? Where would I take my entry? I might actually consider, and keep in mind, you've got your EMA 50 here, so there's every chance there's going to be consolidation or a bounce off here. Okay, you've got proof of that here. Go back onto your charts and have a look to see what candlesticks actually do around the EMA 50 and the EMA 200. Okay, those are familiar points where you will see weird behavior tend to happen. Things like this, for example, where you get a 15-minute reversal, or the wicks will bounce off, or something along those lines, or candlesticks will tend to hover around that area briefly. If you're seeing that, understand, try and analyze that, and try and figure out what is actually going on around those points, and then ensure that your own strategy includes all of that sort of stuff. So, for example, if I'm hitting an EMA 200 and I've already collected my 30 to 50 pips, I would exit my trade right there. There's no point in me continuing on because the market may enter into consolidation for half an hour, 45 minutes. Do I want to sit there and wait for that? Even if it pulls back for a candle, do I want to be unnerved if that candle is 15 pips and I've just lost 15 pips of profit? Hell no. So what I'll do is I'll exit that trade and look for another entry. Okay, so I look to see here, it bounces off here. Now what I would do is, if I needed to take a trade, I'd wait for the market to possibly break past my EMA 50. Here, this is 3 or 4 candles going up. This possibly breaks past the EMA 50. The body breaks outside of that. This candle goes up, and I might take my entry here. That's 30 pips in 2 candles. Why did I take my entry here? Because again, I needed confirmation from the market that it's had enough of hovering around here for a while. Okay, this broke through, this one broke through, right? Now again, why I like my pound NZD and pound AUD? Because these two tiny candles here still give me 30 pips in movement. So keep in mind, guys, you don't have to jump in really early, because chances are that you're applying more risk to yourself, more than necessary. So in this case, I'm not seeing a clear trend movement. This is a clear trend movement. I'm waiting for the market to show me something that it's done. Now, what you could also do is draw a line somewhere along here. Give me an average of this, and say when the market breaks right above it. So say for instance I take this line to be it, and say most of this crap here, this consolidation happens below my 23.6 line, right? When the market breaks above it, and remember what I said earlier, it's not where the head of it breaks above whilst this is, still 5 minutes remaining and you jump in right here. You don't do that. You let that candle complete. You want this body to complete above this line here, and then you take an entry off here. You could wait for the pullback, or you could jump in straight off, right? Generally speaking, I wait for a little bit of a pullback, because say for instance my spread is about 2 pips, market pulls back 2 pips, I jump in around that time. When the market goes back into, say, a green candle, I'm already in profit, right? So if I was to calculate just this, where am I, this tiny green candle, that's about 6 pips right there. It did push up to about 11 pips, right? But in 2 candles, we're at 30 pips. We've hit our profit margin, and we get the hell out of there. For a lot of people that would have been trying to collect so much more, look at it this way. That went to 30, and then it went to 30, and then it pulled back down to 13, 15. That would have been the bottom of this one here. So that's what I mean. You hit your 30, or you aim for your 25 or whatever it is. Take it and leave. Go enjoy your life. That's the whole point of being a lifestyle trader. You're going to make enough money to live well, and then walk away. Don't get caught up in this sort of stuff. All right. So let me quickly summarize. I think I've been doing too much talking. So you're looking for patterns. You can draw in your support and resistance lines. Pay attention to the wicks, guys. The wicks will always tell you what the market is actually doing. So say for instance, again here, let me get rid of this. Say for instance here, when the market is pushing up and you've got your wicks to the high, market pulls back down again, wicks to the high again, pulls back down. You know the market is going to go in the opposite direction, right? So what I could do here is draw in my Fibonacci and look for signs from either my 50, 38.2, or most definitely from the 68.1. When 61.8 gets penetrated like this, right, and you see this sort of behavior push down, market doesn't break, and then you have a long candle off that, you can even wait for this. And I've seen this more times than none, is when the market does break past the 61.8, something like this does happen. You can probably apply some of your binary trades off of this, where the market comes back down again below the 61.8. You can take this trade. Now, if you have seen this behavior happen, look at this. This is 3 instances, and when the market has actually hit this line and then bounced back up. You know what that means? That means you could take a trade off the next candle going up. And where would I take it till? From here, I'll take it to the EMA 200. It's about 17 pips. Or in and out. And in how many candles? 1. Remember the pullback, 2 pips. By the time this is green again, you're in the money. Up to here, you're done. If the market is doing this, you're pretty much guaranteed the market's going to head in this direction for a bit longer. Okay, again, currency pairs, my pound pairs, I love. My absolute favorite is the pound AUD and pound JPY, great as well. With everything else like Euro USD, Euro JPY, AUD USD, AUD JPY, all of those are more of my binary pairs. that I tend to like because they behave well around, say, the 61.8 ratio. The Euro JPY pair gives me a lot of wicks, which I like in terms of binary options trading as well, that sort of stuff. So look, guys, I don't want to make this video way too long. I hope that does help you with your analysis in when to enter. Learn your patterns, study your wicks. Certainly put in your support and resistance lines. Look for price points. Quarters theory. For those of you that don't know what the quarters theory is, there's a book on the website on connectwithshiva.com. Go into the downloads page. Scroll halfway down. There's a trading book called the Quarters Theory. Have a read of that. That will explain everything in depth. Focus just on collecting a certain number of pips. That's the only thing that's going to help you be consistent. Select a number of currency pairs. In this case, for those of you that are new, especially for those of you that will trade during the Asian session as well, and you don't have to, guys, because it will give you moves during the London and the New York sessions as well. But during the Asian sessions, there are going to be times where you'll easily get about 100 pip moves. So if you can actually wait for confirmation to take your entry, you'll easily be able to get about 30 to 50 pips that way. But for those of you that are new, pound AUD, pound NZD, study them, look for the patterns, jump on a Saturday, on a Sunday, or whenever you get some free time, jump in front of your charts and have a look to see those patterns, to see what's actually happened, what the markets have shown us. Look at this. This is about a quadruple top movement before the market actually strikes back down again. So, and also for those of you that don't understand this template really well, the reason why I like this template is because it's already, the ribbons have been color coded, right? This is not my template. I have recreated this a little bit, and it's on my website, so you can download that. But what I used to do previously is I used to measure based on my server time here when the Asian session will start, when the Asian session will finish, when the London session will start and finish, and then New York session. And the reason why I used to do this is because we always trade multi-session. Always. We're always looking for patterns to happen multi-session. We're always looking for specific moves to happen at session transition. So, like the false moves to happen. And if we see these pattern movements, for example, this here, once this happens, I wouldn't exactly jump straight into the market collapsing here during the middle of the Asian session. Why? Because this is possibly going in towards the middle end of the Asian session. So this would be early afternoon, maybe just after lunch or so. And I'm thinking, well, I don't think the market, and I'll have a look at the news quickly and say, okay, there's some key pieces of news that's going to be released. And I'd say the market makers are most likely going to utilize that to do a move in the market. So for that reason, I will use these ribbons and say, okay, if this is too much in the middle of the Asian session or the London session, I doubt the market's just going to automatically go for a move. If it's going to do it, it possibly will do early on within the session or late in the session, never pretty much in the middle of the session. So I would not count this to be the actual move, and then a lot of people just jump into it. The other thing is when you see massive candles, unless they produce wicks for you, they are a false move candle, right? Trends are not massive candles. You will never get massive candles that show you trends that way. And never rely upon it. Again, don't jump into the hype of that movement. And lastly, guys, again, I always tie this off when it comes to trading. You've got to be very wary of your own emotions. Be very wary of what makes you tick. A lot of people are still lying to themselves. Don't lie to yourself in regards to how you react to a situation. Would you get excited and then jump into something? Don't do that, because at the end of the day, you're the only person that's going to hurt in this. You're going to lose money. Practice your setups, constantly practice it. Sometimes, and guys, I still do this. I don't take every single trade out there. I still do this. I will have the charts open and I will stare at it and I will be screaming at my screen and saying, hey, sucker, I know what you're going to be doing. You're going to do this, and then you're going to go in the opposite direction, and you're going to, something, and I would even tell it, this is where my entry would be. Doesn't mean that I'm going to actually specifically go into a demo account and demo that. You don't need to, but I do still practice where I can actually look at the screen and say, this is where the market's going to be moving, right? So do that whenever you can. You don't have to always trade. The more you do it, I guarantee you, like, if you put in time doing it now, by the end of the year, next year, the year after, you're going to be making a killing trading. That's if the market still exists. If Donald Trump or Hillary don't blow it up. If the market still exists, you really will be making a bundle of money through Forex. Okay? Alrighty. All the best. Enjoy your weekend.